Thank you, Pak Kamal, for making this event happen. I think a lot of credit goes to Swa, who has been an excellent partner last year and this year, and those are the 2 years that we published this ranking of the top 100 Indonesian brands. When we came to Indonesia, we just wanted to make sure about certain things, that we have local partners and expertise here, so that we understand the market very well, we understand what the brands and companies and organizations are doing. And I think with WIR and with SWA, we have that understanding of a grassroots level from the market. So again, I'd like to thank both of them. I would also like to thank all the brands here who have given us an opportunity to create something without which this would have not been possible. There have been some great brands here, and I think there is potential to grow in every market, so it would not be right on my part to say that yes, you can grow, every brand can grow. But Indonesian brands have grown very well. Yes, there's a long way to go when you compare them from a regional or a global point of view, but within Indonesia, I think the brands are reasonably strong. I'll just quickly take you through some of the thinking that we've had when we talk about brands. And brand is, spending money on brand is an investment. It is not an expenditure, is how we look at it. Because it delivers you returns. You cannot see that on the balance sheet straight away, and that's why we have this value-based ranking. So it tells you how much your investment is actually delivering in terms of the value for the brand and the value for the organization. We've been tracking it for a long time, for the last 12, 13 years. So we can say organizations that have focused on the brand have been growing quicker and faster, and all of them have higher share price. Just to give an example, and we track it every year, when we release the top 100 rankings and the companies do their own press releases around it, the share price goes up immediately. CNB in February did a very large PR campaign. The share price went up 3.8% on the day when they announced that they are the #1 in Malaysian bank. So it has a direct impact on investor sentiment, it has a direct impact on the value of the brand, it has a direct impact on the share price as well. We are not in the economy anymore where you can just sell products. It's an ideas economy. And I think if you look at the top 3 brands in the world, that just proves more what I'm saying. Apple wasn't there 15 years ago, 20 years ago. It started off as an idea. It's the #1 brand in the world, #1 most valuable brand in the world, $116 billion US just to buy the name Apple. That's how strong it is. And the companies who've been there 150, 200, 300 years are all way down the ranking. So it doesn't necessarily have to be a company that is 100 years old in the business. You can create a brand in a very short time frame, so long as you focus on it and you drive it effectively. Google is another one. There was the Yahoos of the world who were always there as search engines. Microsoft had a massive financial and marketing muscle behind lots of things, but they did not capitalize on a lot of things that it could have. And Google came and just took over the whole space, and it is one of the top 3 brands in the world. They were #1 for 3 years running before Apple took over. So it is an ideas economy, and it's ideas that people are willing to pay for. It is the ideas that are really driving the organization. We call it innovation in certain areas, we call it superior service in certain areas, we call it better product features, but they're all ideas at the end of the day. The brand is the most powerful intangible of everything. So because of all the intangible value, that's the maximum value. 60 to 70% of the intangible value of the company is in the brand, if you're a brand-driven organization. And we say this, we said this earlier also. When you look at your share price and when you look at your balance sheet, there's a huge gap there. What is as an asset on your balance sheet and what you have as a share price is many times more. Where is the difference coming from? It's because of the intangibles that are there, which people are willing to pay more for. And of that difference, a very large part of that is the brand. And if you're not focusing on that, if you're not managing it, technically, what you're managing is only half the company. Because the global average is now 52% of the company's value is in the intangibles. It has become a leading indicator for driving business strategy. It has become a leading indicator to make some investment decisions. It has become a leading indicator to say which products I should launch, which customer segments I should target next, which markets I should enter, and so on. So it's not something that is just that you see here once a year and see that you've grown from 3 billion to 4 billion and then feel good about it. It can be used very effectively as a business tool which you can apply. This is the chart that we've created now. The bottom red line is all the S&P 500 companies which are ranked on the S&P 500, their share price. Of all the S&P 500 companies, the last line. And the lines above that, and this has been tracked from 2007 onwards, so it's a reasonably long period to say with surety that it just demonstrates what I was just saying earlier. These are all the companies that are ranked in the top 500 global brand rankings of brand finance. So top 50, top 10, top 500, even the top 500 perform better than the S&P 500. So, which is a clear indication that a strong brand drives better business performance at the end of the day. And since I'm not an authority, I've decided to depend on one. Mr. Warren Buffett says, if I have the choice, it's been said by many people, it's been said by McDonald's as an organization, it's been said by Quakers as an organization, it's been said by P&G as an organization, but if you have to manage one of the two, there are investors, there are industry captains out there who rather manage the intangibles than the tangibles. I think the key word there is skillfully manage the intangibles. And if you're not skillfully managing it, if you're just leaving it on its own to get managed, that's also a way to manage, but that doesn't really gives you quantum returns on managing it well. So when we say why Singapore Airlines has 47% of the company's value in the brand, they've been managing it well. Will they continue to do it like that? We don't know. Because the whole market catches up after some time and you've got to then reinvent yourself to say, where do I go next? So that's a constant reinvention. But the fact is, yes, there are people who choose certain brands because they believe in the brand. There are people who choose certain companies and products because they want discounts. Those are not the strong brands. For those of you who are interested in knowing more about other rankings, there are lots and lots of reports on our websites across categories, across industries, telecom brands, banking, financial brands, retail brands, spirits and liquor brand, airline brands. You can download them for free. You go to branddirectory.com and download it. What I want to tell you about is give you this. This is the world's only ISO certified, ISO compliance rankings that are published anywhere in the world. Valuation has been an ISO certified process since October 2010. There's no other ranking based on value that's published which is compliant to the ISO process and ISO standards. So this is also the closest that you can get. This is something I was talking earlier also in terms of understanding the intangible space. Unless we understand what's happening in that space, we really cannot guide ourselves or some of you to say what you should be doing next. So we track almost 57,000 companies across 128 stock exchanges around the world, which allows us to capture almost 99% of what's happening in the tangible and intangible industry. Then we cut it down by country, by product segment, by geographies to see which country has what kind of mix, etc. So a lot of the work that you see, which is very simply published as a ranking or as a value, has a lot more background to it and almost 6 months of work that goes into it. This is Indonesia. Now the top three, the dark blue and the green, and that what you see is the intangibles. The grey one is the tangibles as declared by all the listed companies on the Indonesian stock exchange. Now you can see, look at the extreme, Look at the extreme left one. This is the global average. A global average is 50, and the rest is 50 is intangibles. Indonesia, the intangibles are so much larger than the tangibles. So when you look at the value, the enterprise value of the Indonesian companies, just about, on an average, just about 32% is on the balance sheets. This isn't. That makes it even more important for the Indonesian companies to be driven by brand, and just show that they have to be driven by brand rather than by what they have as tangible assets on the balance sheet. There is a positive investor sentiment also. Now this kind of a value shift can happen for a variety of reasons also. If the stock market is on an artificial rally, then also we see there is a very large amount of, but because it's been tracked for the last 11, 12 years, and we've seen that percentage to be consistent, that's why we have reasons to believe that this is not just artificial increase of stock price leading to high increase of intangibles. Vietnam is the other way around, as an exception. In fact, we were talking to some people there about Vietnam last week. And Vietnam is all about tangibles. There's very little intangibles there, which just shows the number one Vietnamese brand, we don't publish that, is 657 million, that's it. It's such a small brand. The number one brand there is really, really tiny. They're not even $1 billion. And after the top 5, they all drop below 100 million. That's how quickly it drops. What are the key variables? So when you look at the rankings, you'll see these are the 3 or 4 variables that you see. So you'll see a ranking there. The ranking is a factor of many things. So don't just look at the ranking and feel bad if you dropped a few places or say, oh my God, we're not doing well. No. You have to look at what is the enterprise value, and that's increased or decreased. You also have to look at what is your brand rating and based on the brand strength index. So you see an A or an A plus or a double A plus there. That's a brand rating. If your rating is improving, which means the brand is becoming stronger, irrespective of whether your company is growing or not. So the rating is very important, and that's also a competitive rating. So if you have 3 or 4 different brands in the same category, you can compare themselves with each other to say which brand is strong, which brand is weak. The percentage of brand value to enterprise value, you can then compare this to say if it's a very low percentage, that means the brand is not driving the business. Your business is driving the brand. A higher percentage means it's a very brand-driven organization. So if you look at most of the American brands and the European brands, the Asian exception being Korean and Japanese companies, where the percentages are very high, 23, 25 and above. The rest of Asia sort of straddles between 6 and 12% of EV to enterprise value to brand value. And we've seen that trend across all categories, and it only goes down from there, which is not a very good thing to have. If you look at some of the bank brands here, they're like 11%, 12%. Go to Europe and US, they're all 34, 35, 25, 28%. So they're very brand-focused businesses. And then you look at some of the strategic options and implementations, and then look at. So don't look at, because a lot of times you may go down in rankings because some other brand has grown. So your value may still grow. So look at all the things. Look at your brand value to enterprise value percentage. If that's gone down, look at your brand value itself. Look at your rating, brand strength rating, and then look at ranking. Not in isolation, because you may still have a very good positive curve. The other thing I want to mention is just because your business value is growing doesn't necessarily mean your brand value will also grow. We have enough and more examples and exceptions of that. I'll quote just one, which is HSBC, and the top 500 global brand rankings. They were number 1, they dropped to 3. The enterprise value went up 47%. The brand value went down 17%. Because the brand value is based on the future earning potential of the organization, not your past performance, not your current performance. The share price is a mix of both. The brand value is based on how likely you are going to be successful in the future. This is just to give you an illustration about also the size of the company doesn't dictate, just because you're a big company doesn't mean you will be a very large brand also in terms of value. So this is in Singapore. I've used last year's figures. The enterprise value is 29 billion of DBS. For the first time, they became the number 1 brand in Singapore. And the brand value is 3.4 billion. Look at Singapore Airlines compared to that. So the outer circle is the value of the business, And the inside light blue circle is the value of the brand inside the business. And look at Singapore Airlines, how big that circle in the middle is. And that's a brand-driven organization. The TBS, which is the number one bank in Singapore also, is there, but the percentage is just about 11%. Singapore Airlines is 47% of the value of the business is in the brand. That's Wilmar, even bigger than DBS, but in terms of value, even lesser. They're about 7% of the total value of the businesses in the brand. It's a B2B company, commodities, so again, not very brand focused. They sell as much as they want to sell, for example. So these are things that really don't allow organizations to focus on the brand. When they're selling very well, when they're doing very well, when they're growing very well, saying what's the need. That's UOB and so the number 4 and 5. Look at FN and how small it is. It's become even smaller now after the split, but the brand value is remained the same. UOB 25 billion in terms of enterprise value, which is far bigger than Singapore Airlines, 6.6 billion, and brand value is only 2.1. So you look at what's happening in the industry, what's happening to some of your competitors. Are they growing in terms of percentages? Are they becoming a stronger brand? And that will give you a lot of indications. That's how you use some of the information that's published here. This is just to give you, when you see the double A or when you see the triple A or when you see an A, how it is calculated, it's a factor of 3 things. One is the input, which is everything that the company controls 100%. So if you're an airline, how many routes you're going to fly, what kind of customer services you'll offer, what kind of pricing, how many aircrafts, and everything that is under your control, not under competition's control, is all your inputs. If you're a bank, how many ATMs you'll open, how many branches, what products you'll offer, what pricing, what car, all your inputs. Those inputs generate a certain amount of brand equity for the customer, whether it's loyalty, whether it's likability, desirability, and repeat purchase, etc. And that brand equity generates the business value. So there's a correlation in the input equity end. That's how we have 32 parameters here which help us calculate that brand rating to see how strong or weak the brand is. The weightage is 70% customers on that as well, because the brand is something that is lived by the customer. So 70% weightage is on the customers, 10% finance, 10% staff, and 10% external. What you get at the end of the day when you see your rating. So for example, if your score is 60, you're an A+. If your score is 50, you're an A-. So it grows to AAA as your score grows. So you can also see against your competitors. So if you're at 70 and a competitor is 52, you don't have to worry about so much, for example, because they're reasonably far behind. But if you're at 66 and they're at 64, then you've got a lot to worry about, saying they can catch up very, very quickly. Irrespective of the size of business that they might have, you have to see how strong that competitive brand is. Valuation is a tool. It's been used for a lot of technical applications so far, but in the last 5 to 6 years, it's become more strategic. Before we only used to do a lot of impairment and purchase price allocation and transfer pricing and this, that, and the other, but now it's a lot more things. You can apply it to any strategic aspect of the business to understand whether that will generate value in the future or not. So it's not just to value what you have today, but you can use it very effectively to understand where the future value is going to come from. There are different benefits to different audiences. So if you're in marketing, then there are different set of benefits. It allows you to speak the language that the CFO wants to listen to. It allows you to put a cohesive framework over everything to see how all your investments are generating what kind of returns. It allows you to leverage all your market research, which is in different parts and different pockets across products. For CFOs, they start to look at brand as an investment or as an expenditure. So that's a huge shift that we've seen across the world. So it allows you to quantify the value of brand investment for the CFO, and we've seen them to be more receptive about spending on the brand and marketing activities once they're aware of what it's contributing. And the CEOs, it's a financial benchmark, and it helps them enormously in some of the governance aspects of the brand, so that they can know with some amount of surety that whether it's growing or not growing. These are the 4 areas that we ask all the companies to focus on, whether internally or through some external help, or first is measure. You must know what your value is and where it's coming from. The other is then manage, how well you're managing it so that it doesn't go down, it grows up continuously in the right direction. The third one is maximize. Now that you're measuring and managing it, how do you maximize it? How do you grow from 5 to 7? Is there a target, or you just want to let it grow naturally by itself? And sometimes you'll be surprised why it went down, sometimes you may be happy that it went up significantly. And the fourth bit is monitoring, which is you can monitor it on an ongoing basis and see where the value is getting impacted. This is just an example, and while we've used the report-term countries, this could be products, it could be customer segments, it could be anything that you want to use to say each of them how much value they can generate. So you can actually calculate by geography, by customer segment, by product, by price point, whatever you want, to see if you're making an extra effort, there's a cost to it, there's an uplift there, and there's a base case, so the total value can become from X to Y, and minus the cost, what it would be. So you can monitor it and factor it on an ongoing basis. These are just different clients we just used 4 from different categories around the world who've been using it for a long time. A lot of these use them as board's performance KPI as well. That's all. So I think it's a very good piece of information, and again I want to congratulate and thank SWA for making it happen, to bringing it to the organization in Indonesia the way it is. It's something that you can immensely contribute to no matter which part of the organization you're from, and you can benefit from it. Use it, it's available to you as information. You can use the ranking in your annual reports, you can use the rankings with the investors. It's free for you to use, so benefit as much as you can from it. Thank you.
Thank you.